Picture this. It's early 1901, and two railroad titans are locked in a financial war that's crashing the entire stock market. James J. Hill controls the Great Northern Railway. E. H. Harriman runs the Union Pacific. Their battle for Northern Pacific Railroad is driving stock prices through the roof and threatening market collapse. Then J.P. Morgan steps in and forces both magnates to merge their empires into Northern Securities Company under his control. He doesn't ask nicely. He makes them obey. When you're powerful enough to dictate terms to other billionaires and reshape entire industries with a single meeting, you're not just wealthy anymore. But how did America reach a point where one man could wield this kind of financial power? 2. The Wild West of Wall Street, when banking was pure chaos. To understand this, we need to go back to when America's banking system was basically the financial equivalent of the Wild West. Imagine if your bank could just vanish overnight, and that was totally normal. You wake up Monday morning, walk to your local bank, and there's a handwritten sign on the door. Sorry, we're broke. Your money's gone forever. This wasn't some nightmare scenario in the 1870s America. This was Tuesday. The banking system back then was like playing Russian roulette with your life savings. Thousands of banks collapsed across America between 1870 and 1900. Your great-great-grandfather could work his entire life, save every penny, then lose it all because some banker in another state made a bad bet on railroad stocks. The Panic of 1873 wiped out countless families who lost their entire savings in a single afternoon. Stories like this happened thousands of times because America had no centralized oversight like today's FDIC. Banks operated with minimal federal supervision. The Office of the Comptroller watched national banks, but state banks were largely on their own. The boom-bust cycles destroyed entire towns faster than you could blink. Railroads would announce new construction, banks would loan money like candy, land prices would skyrocket, then reality would hit. When the railroad project failed, banks would collapse, businesses would close, and entire communities would become ghost towns. Major panics hit in 1873, 1893, and 1907, each one devastating depositors who had no federal insurance protecting their money. Bank runs spread like wildfire. Someone would spread a rumor that First National Bank was having trouble. Within hours, hundreds of people would line up demanding their money. The bank would run out of cash by noon and close forever. These rumors killed banks faster than bad Yelp reviews. Here's the twisted part. This chaos was incredibly profitable for certain people. While regular families lost everything, smart money knew exactly when and where to strike. They would wait for banks to fail, then buy up the assets for pennies on the dollar. But one family saw opportunity where others saw disaster. They discovered something that would change everything. 3. The Vulture strategy, buying empires for pocket change. The Morgans turned financial disasters into their personal shopping spree. While everyone else panicked during market crashes, they positioned themselves as America's financial first responders. But instead of saving lives, they were saving companies for themselves. Here's how their Vulture strategy worked. When financial panic hit and companies started drowning in debt, most investors ran for the hills. The Morgans did the opposite. They swooped in like bargain hunters at a Black Friday sale, except instead of discounted TVs, they were buying entire railroad empires and steel companies. During the 1893 panic, Morgan acquired railroads at roughly one-quarter their peak valuations. As documented financial records show, many investors bought stock in collapsed lines at pennies on the dollar. The genius move was creating liquidity when everyone else was broke. Morgan's firm could draw on European and domestic credit lines that other banks couldn't access. This gave them incredible negotiating power during crises when private banks were making gold swaps just to survive. Desperate company owners had two choices: sell to Morgan at his price or watch their life's work disappear completely. It was like being the only person with water during a drought. You name your price. The reorganization process was where things got really interesting. After buying a distressed company, Morgan wouldn't just fix it and move on. He would restructure everything, eliminate competition, and cut costs ruthlessly. Then he would merge multiple companies together, creating massive monopolies under his control. The Carnegie Steel acquisition in 1901 cost Morgan $480 million. That's over $13 billion in today's money. But this purchase gave him control over America's entire steel industry. This strategy was basically playing Monopoly with real money and real consequences. While families lost their savings and workers lost their jobs, Morgan was collecting entire industries like Pokemon cards. Critics accused the family of profiting from others' desperation, which was exactly what they were doing. When people are drowning, you can either throw them a life preserver or sell them one at premium prices. But Morgan's appetite for control was about to reach levels that would shock even his critics. Soon, he wouldn't just be buying private companies. The puppet master, when private citizens controlled government money. He was about to rescue the United States government itself. By the 1890s, J.P. Morgan had more actual spending power than Uncle Sam. And when America faced financial disasters that could destroy the entire country, politicians called Morgan. The 1893 financial panic hit America like a freight train carrying dynamite. The Philadelphia and Reading Railroad collapsed, triggering what economists call a 25% drop in economic activity. 1 out of every $4 in the economy just vanished. Unemployment shot up to 20%, which means if you had 5 friends, 1 of them lost their job. Millions of families faced complete financial ruin while the government watched helplessly from the sidelines. By 1895, the U.S. Treasury's gold reserves had fallen below $100 million, threatening America's ability to maintain the gold standard. Without adequate gold reserves, the entire currency system would collapse. This is where Morgan swooped in like a financial superhero, except instead of saving Gotham City, he was saving the entire country. Morgan organized the most dramatic government bailout in American history. He put together $62 million in gold, that's over $2 billion in today's money, and essentially loaned it to the United States government. Think about that for a second. A private citizen had to rescue America because the government was broke. This wasn't charity either. Morgan made sure he got paid handsomely through bond deals that generated massive profits for his bank. This rescue mission turned Morgan's private bank into America's unofficial central bank. When politicians needed money, they came to Morgan. When other banks needed emergency cash, they came to Morgan. He was like having Batman, except instead of fighting crime, he was controlling the entire economy from his private office in Manhattan. The 1907 panic proved this point again. Another financial crisis hit, and once again, Morgan had to organize a bailout to prevent total economic collapse. He brought together other wealthy industrialists and forced them to provide emergency funding to struggling banks. The government stood on the sidelines while private citizens decided America's financial fate. These repeated crises finally convinced politicians that America needed a real central bank, not just Morgan's personal rescue service. The Federal Reserve Act of 1913 was a direct response to these private interventions. But before that system could be created, Morgan would face his ultimate test of power, a financial war between 2 railroad titans that threatened to destroy the entire stock market. The nuclear financial showdown. When Morgan made billionaires play by his rules. That test came in 1901 when 2 railroad titans launched a financial war that nearly broke the entire system. What happens when 2 billionaires decide to destroy each other over one railroad? James J. Hill and E. H. Harriman were about to find out. These weren't just rich guys having a disagreement. These were 2 financial warlords with enough money to buy entire states, and they were about to trigger chaos across Wall Street over control of the Northern Pacific Railway. James J. Hill was the railroad king of the Northwest. This guy built his empire by connecting remote territories to major cities, making fortunes by moving grain, lumber, and people across vast distances. E. H. Harriman controlled the Union Pacific Railroad and had his sights set on expanding eastward. Both men looked at the Northern Pacific Railway and saw the same thing, the missing piece that would complete their railroad monopolies and make them unstoppable. The battle started quietly enough. Hill and his partner J.P. Morgan thought they had secretly secured control of Northern Pacific through stock purchases. Meanwhile, Harriman was doing the exact same thing from his side. Neither group knew the other was buying until they both showed up claiming ownership. This was like 2 people showing up to the same parking spot with the same key, except instead of a Honda Civic, They were fighting over a billion-dollar transportation empire. When both sides realized what was happening in April 1901, the financial nuclear war began. Hill and Harriman started buying Northern Pacific stock like they were competing for the last iPhone on Black Friday. The stock price went absolutely insane, jumping from $110 to $1,000 per share in a single day. Think about that for a second. If you owned one share in the morning, you could sell it for 10 times more money by dinner time. This wasn't normal market behavior. This was financial warfare. The human drama was intense because both men had enough money to literally buy entire states. Hill was known for his aggressive expansion tactics and iron will. Harriman was famous for his ruthless business moves and never backing down from a fight. These two financial giants were playing chicken with the entire American economy as their battlefield. Neither wanted to blink first because losing meant watching their competitor become the most powerful transportation baron in history. The stock manipulation was creating chaos across all of Wall Street. When Northern Pacific stock hit $1,000 per share, it triggered massive margin calls throughout the financial system. Other investors who had borrowed money to buy stocks suddenly owed way more than they could pay. Multiple banks faced potential collapse because their portfolios were getting destroyed by this one railroad fight. Picture dozens of dominoes falling because two rich guys couldn't share their toys. Banks that had nothing to do with railroads were suddenly facing serious trouble. Investment firms were getting margin calls that could wipe them out completely. Panic selling was spreading like wildfire across the market. From his office in Manhattan, J.P. Morgan watched this financial nuclear war unfold like a chess master calculating his next move. Morgan had partnered with Hill, but he could see that this battle was going to destroy everyone involved. The stock market was experiencing serious volatility. If something didn't change quickly, the damage could spread throughout the entire American financial system. Morgan made his power play by calling both men to his private library. This wasn't a friendly business meeting. This was a financial intervention led by the most powerful banker in America. Morgan essentially told both billionaires to sit down, shut up, and listen to his solution. He wasn't asking nicely. He was giving orders to men who were used to giving orders themselves. The solution was brilliant and terrifying at the same time. Morgan forced both Hill and Harriman to merge their railroad empires under a new company called Northern Securities. This holding company would control the Northern Pacific along with other major railroads, creating the largest transportation monopoly in American history. Instead of destroying each other, both men would share control under Morgan's ultimate authority. This move made Morgan the ultimate railroad kingmaker. He didn't just stop a financial war, he reorganized the entire American transportation industry according to his vision. Northern Securities controlled rail lines from the Great Lakes to the Pacific Ocean. This gave Morgan's alliance unprecedented power over how goods and people moved across the continent. Both Hill and Harriman had to accept Morgan's terms because they had no other choice. The alternative was mutual destruction and financial ruin for everyone involved. Morgan demonstrated that even the richest men in America had to play by his rules when push came to shove. He wasn't just wealthy, he was the financial authority that other authorities answered to. The immediate result was market stability. The panic selling stopped. Stock prices returned to normal levels. Companies that were facing trouble from margin calls got breathing room to recover. Morgan had essentially performed emergency surgery on the American economy and saved it from serious damage. But this power grab created an even bigger problem. Northern Securities represented exactly the kind of corporate monopoly that reformers had been warning about. One company now controlled transportation across half the continent. This level of economic concentration in private hands made politicians and regular citizens extremely nervous about the future of American democracy. The Supreme Court agreed. In 1904, they ruled that Northern Securities violated antitrust laws and ordered the company dissolved. Morgan had won the battle but lost the war against government regulation. Yet Morgan's real legacy wasn't just stopping financial wars or creating massive monopolies. His most lasting impact came from the financial tools and systems he created during these power struggles. Innovations that quietly revolutionized how money works in America. 6. The innovations that built modern Wall Street. These tools completely transformed how money moves through the American economy. Every time you use a credit card or get a business loan, you're using systems that trace back to Morgan innovations. The bond underwriting process Morgan developed in the 1890s, where banks guarantee to sell a company's debt to investors, became the foundation of modern corporate finance. Trust companies that Morgan created to manage wealthy assets evolved into today's wealth management industry. The Morgan family basically created the entire playbook for investment banking that Wall Street still uses today. Before them, banking was simple. You deposited money, they loaned it out, everyone went home. Morgan turned banking into a sophisticated machine for moving massive amounts of capital around the economy. Modern bond market conventions trace directly back to Morgan's standardized procedures for evaluating creditworthiness and pricing corporate debt. Here's where things get sneaky. These innovations looked helpful on the surface, but they concentrated enormous power in fewer hands. Morgan's investment banking model meant that a small group of wealthy financiers controlled access to capital for entire industries. If Morgan didn't like your business plan, you couldn't raise money, period. It was like having one person control all the Wi-Fi passwords in the world. The railroad reorganization process Morgan pioneered became the template for modern corporate restructuring. This approach, called Morganization, described Morgan's practice of reorganizing railroads through consolidations in the 1880s and 1890s. He'd buy failing companies, fire management, eliminate competition, cut costs, and merge them to create massive monopolies. The Carnegie Steel merger of 1901 demonstrated this strategy's ultimate scale. Morgan created America's first billion-dollar corporation. Trust companies and holding company structures were Morgan innovations that changed everything. Trust companies could hold and manage assets with fewer regulations than traditional banks, giving Morgan flexibility to move money and control investments. Holding companies allowed him to control vast industrial empires with relatively small amounts of actual capital, like being the puppet master of a dozen different companies while only owning the strings. Modern merger and acquisition practices are basically Morgan's playbook, updated with smartphones and PowerPoint presentations. The strategic approach Morgan used, identifying undervalued companies, acquiring them during financial stress, then reorganizing them for maximum efficiency, remains the foundation of contemporary M&A activity. Private equity firms today use essentially the same strategies Morgan perfected in the 1890s. But here's the question that should keep you awake at night. Did these innovations actually help ordinary Americans, or just make rich people richer? Morgan defenders argue his methods brought stability and efficiency to chaotic markets. Critics point out that his innovations created monopolies that crushed competition and exploited workers. The honest answer? Both things were true. Morgan's financial tools made the economy more efficient and predictable, but they also concentrated unprecedented power in the hands of a few wealthy families. These innovations solved real problems while creating new ones that still shape how banks operate today. The scary part is how much of this system survived intact, hiding behind modern regulations and consumer-friendly marketing. 7. The Fingerprints, Morgan DNA in today's banking. Today's banking system carries Morgan DNA in ways that would shock most people. Your bank account, your mortgage, your credit score, they all bear the Morgan family fingerprints. Every time you swipe your debit card or apply for a loan, you're using systems that trace back to innovations created over a century ago. It's like finding out that your favorite Netflix show was actually written by someone you can't stand. Let's connect the dots between Morgan's historical practices and the banking world you deal with every day. The way banks evaluate risk and price interest rates, pure Morgan methodology updated with computers and algorithms. The mortgage-backed securities that caused the 2008 financial crisis, those are direct descendants of the bond standardization practices Morgan pioneered in the 1890s. J.P. Morgan Chase represents the clearest example of Morgan legacy in modern banking. This isn't just about sharing a name. J.P. Morgan Chase is literally the direct descendant of the original Morgan Empire. The 2000 merger between J.P. Morgan and Company and Chase Manhattan Bank, founded in 1799, created today's financial giant, which controls over $3 trillion in assets. When you bank with J.P. Morgan Chase, You're essentially banking with the same institution that JP Morgan built during the Gilded Age, just with better technology and slicker marketing. Federal Reserve policies still reflect the original private banker influence that Morgan helped establish. The 1910 Aldrich Plan meeting at Jekyll Island influenced the 1913 Federal Reserve Act that created our current system. That structure remains largely intact today. The 12 regional Federal Reserve banks still have boards of directors that include representatives from private banks. It's like having the people you're supposed to regulate help write the rules they have to follow. The revolving door between Wall Street and the Federal Reserve creates obvious conflicts of interest, where the people making monetary policy might prioritize banking industry profits over public welfare. Former Fed officials regularly take high-paying jobs at major banks, while bank executives get appointed to Fed positions. Modern too-big-to-fail policies echo the Morgan rescue model perfectly. During the 2008 financial crisis, the government bailed out major banks using the exact same logic Morgan used during the Panic of 1907. Some institutions are too important to the economy to let them collapse. Both eras saw private rescues of failing banks, but now taxpayers fund the bailouts instead of wealthy private citizens. This system encourages massive financial institutions to take huge risks because they know the government will rescue them if things go wrong. It's like playing poker, where you keep all your winnings but someone else covers your losses. Banks get to privatize profits while socializing risks, which is basically the Morgan playbook with government backing. Banking regulations often appear consumer-friendly on the surface, but contain loopholes that benefit large institutions. The Dodd-Frank Act passed after 2008 looks tough on banks, but major financial institutions found ways to work around most restrictions. It's regulatory theater designed to calm public anger while preserving banker advantages. The structure of the Federal Reserve, blending public oversight with private banking interests, creates ongoing tension about who really controls monetary policy. Critics argue this design allows private banking interests to capture public institutions, exactly what happened during Morgan's era. What we're seeing isn't just about banking anymore. The Morgan approach created something much bigger, a blueprint that extends far beyond Wall Street. 8. Conclusion. This system became the template for how private interests capture public institutions. The Federal Reserve structure, mixing public board appointees with private bank directors, was a direct legacy of Morgan's era and remains largely unchanged today. Tech companies write internet regulations. Pharmaceutical executives design drug approval processes. Energy corporations craft environmental policies. You need to start asking tough questions about the systems you use daily. Who designed your credit score algorithm? Why do banking fees always seem to favor the bank? Who really benefits when the government bails out massive corporations while regular people struggle? Next time you swipe your card, ask yourself, whose system are you really using? If you're seeking more investigative financial documentaries, be sure to watch the videos on my channel. Thank you for watching this video all the way to the end. If these insights resonated with you, please take a moment to like this video, subscribe to the channel, and share it with someone who could benefit from this message. Your support helps us continue creating content that empowers and inspires. I would absolutely love to hear about your thoughts. Please drop a comment below. I read every comment, and it helps me create better content for you.